You can have the perfect trade idea and still lose money on execution alone, and the reason is almost always liquidity. Liquidity is how easily an asset can be bought or sold without causing a significant change in its price. High liquidity means large orders execute close to the quoted price. Low liquidity means the same order can move price substantially, simply because there isn't enough resting volume to absorb it. Liquidity comes from market participants placing limit orders, the resting bids and asks that make up the order book. The more participants actively quoting on both sides, the deeper that book is, and the more liquidity exists at each price level. Liquidity is not constant. It changes by time of day, by asset, and by market condition. Major Forex pairs like EUR, USD are highly liquid during London and New York session overlap, when the largest number of participants are active simultaneously. The same pair becomes noticeably thinner during the Asian session or around low-activity holiday periods. Crypto liquidity is more fragmented, because trading is split across many exchanges instead of concentrated through centralized market makers. This is why the same asset can show slightly different prices on different exchanges at the same moment, a condition that persists specifically because liquidity is not unified across venues. Liquidity also affects the bid-ask spread directly. In highly liquid markets, competition between market makers narrows the spread. In illiquid markets, spreads widen because participants demand more compensation for the risk of holding a position they may not be able to exit quickly. A critical distinction is between liquidity and volume. Volume measures how much has already traded. Liquidity measures how much could be traded right now without moving price. A market can show high volume from a single large trade that consumed most of the resting book, meaning volume was high but liquidity, immediately after that trade, dropped sharply. This is also where slippage originates. Slippage is the difference between the expected execution price and the actual filled price. It occurs specifically when an order size exceeds the liquidity available at the best price level, forcing the remainder of the order to fill at progressively worse prices. Consider two scenarios trading the same size position in EUR, USD. During the London-New York overlap, the order book might have deep resting volume at every price level within a tight 1 pip spread, and the position fills entirely at the quoted price. During the Asian session, the same position size might only find enough resting volume for half the order at the best price. The remaining half fills at progressively worse prices as it consumes deeper, thinner levels of the book, producing measurable slippage purely due to reduced liquidity, not any change in the underlying pair's value. Liquidity determines whether your trade executes at the price you expect or at a materially different one. It is not fixed, it shifts with session timing, asset, and market structure. And understanding it is what separates traders who account for execution risk from traders who only watch price. If this helped clarify market mechanics, subscribe. A new breakdown posts every Monday.